Coming up, household spending still rising, construction activity slows as building approvals fall, but the copper price is at a 52-week high. We'll have all the details next. It is your daily 10-minute business and finance news wrap for this Thursday, the 4th of April 2024. The Australian share market rose 0.5% today. We'll get the details with Henry Jennings from Marcus Today. But first to property, where the government's target of building 1.2 million new homes over the next 5 years may be at risk. The Bureau of Statistics says dwelling approvals fell nearly 2% in February at just 12,500 homes, led by a huge 25% slump in approvals for apartments. Higher interest rates are lifting costs for property developers and builders, constraining the level of dwelling approvals. So for more, Rhanya Bosch spoke with Tom Devitt, a senior economist at the Housing Industry Association.
This has probably been one of the most well-broadcast downturns in recent memory. We've been saying from around mid-2022, when the Reserve Bank first started increasing interest rates, that this year, 2024, was going to be the trough in terms of new work commencing construction, and that's exactly what we've been seeing. There was a little bit of a bounce back in house approvals in February, but that's mostly just the result of January being seasonally weaker. So these numbers are a lot lower than we need them to be.
So where does this place us in relation to the government's construction targets?
Well, the government wants to see 1.2 million homes built over the next 5 years. At current rates, in recent months, we'd struggled to get to 800,000 over that 5 years. Now, we are expecting the numbers to improve and start recovering from late this year, and that's why our official forecasts state that we'll start a little over 1 million over the next 5 years, but that's still well short of the government's target of 1.2 million, and not just the target, but the amount of housing that we need to really address the current affordability and availability crisis.
You mentioned the housing crisis broadly before, and that's obviously what everyone is interested in at the moment. Where does this all lead to in terms of the housing crisis that we're facing?
Well, unfortunately, it's going to take a number of years before we can really see real improvements. I mean, you just need to look at rental vacancy rates across the country. They're around 1%. Normally, we'd want to see them 3% or higher to have that sort of fair balance between landlords and renters. And on average, they're 1% or lower. So we really need to see that new housing supply entering the pipeline as quickly as possible to address that. And there's a number of policy reforms that we at HIA have been pushing government and the financial regulators and the Reserve Bank to really kickstart that recovery so we can achieve some of these numbers.
That is Tom Devitt from the HIA speaking with Rhanya Bosch. From housing, let's go to the consumer, because transport prices for things like petrol have surged more than 12% in the year to February, but that's helping to push total household spending up 3.6%, according to the Bureau of Statistics. But here's the thing, there's a clear split as to what consumers are buying. So non-discretionary spending surged nearly 7% on the year, driven by those transport costs along with food and health. Now, these are essential items, many hit by inflation and are often hard to avoid. Consumers, however, are spending less, 0.2%, on discretionary goods, otherwise known as non-essential items like home furnishings. For more, I spoke with senior analyst at Moody's Analytics, Katrina L. Katrina, so household spending is up 3.6% over the past year, but there's a clear split between discretionary, which is down, and non-discretionary, which is up. So what does that say about the consumer right now?
Yeah, that's a really good question. So what it's telling us is what we already know, and that is households are under pressure. Households are still forced to be spending more than they were a year ago on those non-discretionary items, so those essential goods and services. And because household budgets are stretched, they're pulling back on those discretionary services and discretionary goods purchases as well, and only spending on the essentials. Because at the end of the day, household budgets are being stretched by higher mortgage repayments, as well as inflation still being above comfort levels.
Okay, so are there any concerns that consumer activity may then add to inflation, or is it quite the opposite in that higher interest rates have hit them hard?
So what we're seeing is that higher interest rate environment is still impacting households. And I think one rule of thumb that we need to remember is that it takes between 6 to 9 months for the full impact of one 25 basis point hike to really manifest in the economy. And so we haven't seen the full impact of that 425 basis point hikes that the RBA's delivered fully impact households and the broader economy yet. So we're still seeing that filter through. And so we will expect to see households under pressure through most of this year.
And what's this likely to mean for official interest rates?
So our expectation is that we won't see the first rate cut in Australia until September. And that's at the very earliest, to be honest, because I think what we've seen from the RBA is that they're treading very cautiously and very conservatively as well when it comes to when they will actually start easing back on policy. They're not going to want to move too soon and risk inflation, pushing back up again. So they're going to take their time and make sure that inflation is sustainably back to that 2 to 3% target range. And we think that the earliest time that they'll be able to do that is September.
Katrina L there from Moody's Analytics.
Now, Market Day on the SBS On the Money podcast.
The Australian share market had a good day today. The S&P ASX 200 up 0.5% to 7,817. It followed some commentary about interest rates in the US, and for that I spoke with Henry Jennings from Markets Today.
Well, I guess it's recovering from yesterday. Last night we had a slightly better and more positive US market, which always helps. We also had some comments from Jerome Powell once again saying that interest rate cuts are back on. Well, not that they ever were off, but there were some sort of concerns that maybe they wouldn't happen sooner, but a lot later. But Powell said that 2024 we would get some rate cuts, in theory, the data all being benign and in the right direction.
So which stocks led the gains?
Well, at the moment, it's been basically the stocks that fell yesterday are the stocks that have rallied a little bit today. The banks and industrials were under the cosh yesterday. They have rallied a bit today. Iron ore miners still under a little bit of pressure due to that iron ore price, but we have seen some of the resource stocks in the lithium, copper and gold space also doing quite well today. So they're basically reversing some of yesterday's losses.
We've spoken a lot about commodities in recent times, namely gold, which has been consistently hitting record levels. But now copper is making news. It's at a 52-week high. What's going on here?
Well, Dr. Copper, as it's known because it has a PhD in economics, has been going extraordinarily well. There has been a problem with supply, especially coming out of Chile recently. We have seen production cuts from a number of copper companies. And there also is this big deficit in copper as well in terms of supply demand, which has been as a result of underinvestment over the last few years. So this growing problem that we haven't got enough copper and there's not enough big copper projects out there has been compounded by those production cuts coming out of South America. So it really is a good news story at the moment. How long it lasts remains to be seen, but at the moment certainly copper is pretty hot.
And where do you see the opportunities for investors?
Well, I think we've had a pretty good run in the first quarter of this year, to say the least. The market hit an all-time high just before Easter. I suspect we're going to see a bit of consolidation. We're heading into bank reporting season. We've also got the budget coming up, but there's certainly no reason to panic. And I guess it comes down to being a stock picker's market, perhaps in the next 3 to 4 months as we head into that Northern Hemisphere summer when things do tend to go a little sideways. But I guess it's going to be the themes that remain the same in terms of whether you're a resource fan or whether you're a banks and industrial fan. That seems to be the way of things at the moment. It's one or the other, and we can't seem to get both firing at the same time. But certainly there will be some opportunities around in the next 3 to 6 months.
That is Henry Jennings there from Markets Today.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional